In this week's video, we'll cover a rare and multiple signal stock market setup that has only occurred 2 other times in the last 60 years. In last week's video, we looked at some powerful annual charts for the Dow Jones Industrial Average. This week, we'll perform a similar analysis, but we'll use the S&P 500. Since the Dow only has 30 stocks, you can make an argument that the charts we're about to review are 16 or 17 times more relevant than the charts we reviewed last week. These are titles of articles that appeared on a popular financial website this week. They all have 2 things in common. The title has a tendency to hint at bearish outcomes, and every single one of the articles had an extraordinarily high number of comments relative to the average article, especially any article with a bullish title. Our purpose here is not to critique the articles, but rather to look at the titles and the number of comments and learn something about retail investor sentiment. While many may believe or want the stock market to go down for a long period of time, in this week's video, we will ask, does the evidence support a long-term bearish thesis? And no matter how cruel it may sound, the market really doesn't care about what any of us think or what any of us want to have happen. If the facts are contrary to any predictions, then the hypothesis is wrong, no matter how appealing the hypothesis. So let's assume that our hypothesis is a bearish one from a long-term perspective. And before we get started, like last week, we will be looking at long-term, big-picture confirmation signals rather than shorter-term timing signals in the charts that follow. This is an annual chart of the S&P 500 index. This is 1954 here, and this is the early 1970s where my cursor is. This is a portion of a longer-term secular trend. This is a 19-year period where the S&P 500 gained 376% from point A to point B. And we have added the 8-year moving average in blue and the 9-year moving average, simple moving average, in red to illustrate some basic concepts. There's nothing particularly magical about them, and the market model does not use them. But we can see during this entire 19-year period, the faster moving average, blue, stayed on top, and the slopes of the moving averages were positive, and price, for the most part, remained above the moving averages, meaning from a long-term perspective, we maintained a full-bore bullish look for 19 years. And we're all familiar with the concept the market needs to consolidate its gains. Market fractals tell us that that expression applies to a 1-minute chart, a 60-minute chart, as well as annual charts. So not surprisingly, after the big gain, the market basically went sideways in an indecisive manner. And in here, instead of having blue clearly on top, we get a flattish look to the moving averages here, telling us that we have an indecisive market. And then in 1981, we can see, if you look closely here, blue is starting to separate. We have a bullish moving average crossover. The faster moving average is now on top, and we can see that. Another expression we're also familiar with, the longer a market goes sideways, the bigger the move that we can expect to get once we get a bullish breakout or bearish breakdown. And in this case, we got a bullish breakout. Very, very similar to this secular move here during this entire 18-year move in the S&P 500. Blue, the fastest moving average, stayed on top, and we maintained a full-bore bullish look from a long-term perspective. The gain from point A to point B was almost 1,100%. If we fast forward to the present day, we have a similar situation. The market consolidated these gains here by going sideways for a long period of time. And much like this period here, the moving averages and price became indecisive, and we were in a very wide trading range. This point here is very, very similar to the present day, where the 8-year moving average is starting to clearly separate from the 9-year moving average. Back here, that was not the case. And in the present day case, on an annual chart, the consolidation lasted for approximately 18 years. This box here is roughly a 20-year period after the consolidation. A secular move began, lasted 18 years. You can make an argument that we're in a very, very similar situation today in terms of a setup. This point A here is very, very similar to this point A here. And that's a factual, probabilistic statement based on things that we can observe. If the evidence changes, then our probabilistic statement and forecast will change. As of November 8th, this is a very favorable setup from a long-term perspective. Let's make the assumption that you're not convinced by one form of input. In this case, that would be using two moving averages where we're looking for a binary event or a bullish moving average crossover. So let's look at the same period for the S&P 500 and add some indicators in a very similar manner to the analysis we performed on the Dow Jones Industrial Average using annual charts last week. This is 1955 here, and eventually we'll make our way all the way out to the present day, or 2017. To speed things along, we're just going to be looking for patterns that we can recognize here. We've cut and pasted some text directly from stockcharts.com about these indicators. You can pause your video player and read this text if you want a little bit more detail. The first indicator is Bollinger Band width. You can see as the market's consolidating here, the Bollinger Band width starts to fall, and this is telling us that we have one of those sleepy, trendless markets here, and as we know, after we move sideways, we can get a big move. This is saying the same thing. When the Bollinger Bandwidth gets low, extremely low in this case, from a historical perspective, and starts to rise, it tells us to keep an open mind about a big move. And remember from last week, we can see CCI, it's exceeded 100. Once we exceed 100 and stay above 100, it can foreshadow an extended move. And TSI, in terms of how we utilize it, is very, very similar to MACD. This is a bullish cross here where blue goes above red, telling us that momentum from a very long-term perspective is starting to improve. So at this point here, we have three bullish signals that we can see, measure, and put in a model. And as we know from the previous graph, after this point here, after we could see this, good things happen for a long period of time. And we know that all good things must come to an end. The market eventually is going to need to consolidate its gains. This is the point here from an annual perspective where momentum starts to slow. And we can see that Bollinger Bandwidth at this point here looks quite a bit different than this bullish look we just reviewed. We can also see that CCI now has dropped below 100 here. We've lost this long-term bullish look that we maintained for a long period of time. And TSI had a bullish cross here. Now we can see, measure, and put in a model a bearish cross. And we can also see here that momentum's waning when the black line starts to turn down. Point of the exercise, the bullish setups look discernibly different than a waning momentum look. And these discernibly different looks give us an excellent reference point for the present day. Does the present day look more like the right side of the screen or these red arrows, or does it look more like the left side of the screen and the green and favorable setups? If we fast forward to November 8th, 2017, the answer is easy. The present day looks a lot like this period here and really doesn't look anything like the bearish turns here where momentum is waning. Bullish cross, bullish cross. Above 100, above 100. Was falling, fell to low levels and turned up. Was falling, fell to low levels and now is turning up. The observable evidence in the present day is very, very similar to the observable evidence here, telling us that this point A here, from a setup perspective, using these indicators along with the moving averages, this point A is very, very similar to this point A here, or the present day or recent past. This point here is very, very similar to this point here. After that, good things happened for a long period of time. Remember, we're not using these as timing signals. We're using them as confirmation signals for the timing signals that we used in the past. If you're watching this video as we went through those charts, you might have thought to yourself, what about valuations? Your chart doesn't take into consideration valuations. What about geopolitical threats? Highly charged partisan politics? Artificial intelligence, which is going to dramatically alter everything in the future. Since charts and markets take everything into account, the charts that we're looking at help us monitor the net aggregate opinion of all market participants. So we can insert any concern or question that we have into the what about equation, and the answer to what about valuations is the market is well aware of valuations. The market is well aware of the political climate in the United States, and the market is well aware of the turmoil between the United States and North Korea. Everything we can possibly think of is being considered by the markets on all time frames. This is what a major turn looks like when the net aggregate opinion shifts from bearish and or indecisive to bullish. This is what it looks like when the net aggregate opinion is shifting from bullish to bearish. And we could say the same thing for all of these signals. Therefore, in the present day, if any of the things that we're concerned about matter, and they may matter, it will eventually be reflected in the charts. Why? Because if it's a problem, price will start to break down, just as it did here, and all of that will eventually be reflected in the math, in price, and in all of the indicators on all time frames. We wouldn't be using these signals as timing signals for a bearish shift. These are confirmation signals after we've used faster signals to monitor the turn in real time. We know the CCM market model doesn't rely on any one set of moving averages, time frames, or any one indicator. So far, we've looked at Bollinger Band width, CCI, and TSI. Is there any other evidence that can add to the weight of the evidence? To answer that question, let's look at some other indicators. This is ADX here. We've covered ADX in past videos. You might remember that ADX can help us determine both the direction and strength of a trend. This is that sleepy, indecisive, trendless look with black ADX here. And when it starts to turn up, as it is here, when green is above red, that leans bullish from a probability perspective. Simultaneously here, we can see that RSI has been able to recapture 70. It's bullish when you're above 70 and can stay above 70. Notice here, the market rallies for years when RSI is in quote-unquote overbought territory. Overbought becomes concerning when we move out of overbought territory and below 70. Here, we've moved above. With PPO that we used last week, the percentage price oscillator, this is a bearish cross here, and now we can see measure and put in a model a bullish cross. After we could see all of this, good things happen for a long period of time. And as you might imagine, when momentum starts to wane and the market finally decides that it's going to consolidate its gains, the look of ADX is quite a bit different at a bearish turn than it is at a bullish turn. RSI has now dropped out of overbought territory. This is the look that gets more concerning from a probability perspective. And instead of having a bullish cross here, we have a bearish cross that we can see, measure, and put in a model. Now that we have a bullish reference point and a bearish reference point, how do the exact same indicators look today? The answer is ADX, RSI, and PPO, if you press pause, all look very, very similar to this point here and really don't look anything like this point here. These are observable facts that help us with nothing more than probabilities. They cannot predict the future. They can help us with probabilistic outcomes, allowing us to assess the probability of good things happening from a long-term perspective, in this case, a very long-term perspective, relative to the probability of bad things happening from a long-term perspective. Based on the evidence here, the probabilities have been and continue to improve. Is there anything else that we can add to this chart that would help us with the weight of the evidence? We've covered the Copic curve in the past. You can see here as the market is consolidating, the Copic curve is falling, and then it starts to flatten out. That's kind of our sleepy look. When the market breaks out, the Copic curve starts to rise from low levels in a bullish manner. When we break out, we get momentum confirmation from Williams percent R. It's able to exceed -20 here. This is a bullish look, positive momentum. And on a long-term chart, as the market's breaking out and turning here, we have a very rare look for rate of change on an annual chart where it comes down to the 0 line and kisses it here. And then as we're breaking out, the rate of change starts to improve and it moves clearly away from the 0 line here. As you might imagine, the look of the Copic curve when momentum starts to wane is quite a bit different than the bullish look. Williams percent R has now dropped out of overbought territory from a momentum perspective. This is concerning. This is more concerning than this look here, which is favorable. This indicator stayed overbought literally for years. This is a bullish look here. This is a concerning look. And rate of change starts to fall rapidly here as momentum starts to wane. So does the present day look more like the favorable setups, or are we morphing into an unfavorable look? It's the same chart. We're just extending it out to November 8th, 2017. And it's pretty clear to see Copic was falling, went flat, turned up. Falling, went flat, and is now turning up. When we break out here, Williams percent R, for the most part, stays in overbought territory. This is a favorable look here, just as this was a favorable period. And very, very similar to this rare look here. Keep this in mind. We're looking at a chart that goes all the way back to 1955. There are only 2 times on this chart where rate of change falls near 0 and then rises. Rate of change falls near zero and then starts to rise. Once was this period here. After we saw the signals, good things happened for a long period of time. This is only the second time we've seen something like this, dating back to 1955, and it's occurring, and it's a setup that we can see, measure, and put in a model in November 2017. Now, if we go back to the original chart and remove volatile price from the equation, we can see in the late 1970s, we had that flattish tight look, and we know from past videos that's when you get big moves, when moving averages start to consolidate and move sideways like this. And then in 1981, if we look closely, we can see white space between blue, the faster moving average, and red, the slower moving average. This is a bullish moving average crossover here. Very, very similar consolidation, flattish look here. And then in 2015, we can see the bullish moving average crossover, and we continue to have the bullish moving average crossover in place. So this point here is very, very similar to this point in here as of November 8th, 2017. And we know after this setup here, good things happen for a long period of time, telling us to keep an open mind about good things happening for a very long period of time. And of course, there'll be plenty of volatility along the way, even if good things happen for a long period of time. Just as there was a ton of volatility between point A here and point B here. You can see how the moving averages and trend following techniques help us filter out all of that annual volatility, year-to-year volatility in this case, because we maintain a bullish look the entire time from point A to point B. Now, there's a reason why we chose the Dow last week to perform the annual analysis, because we have data going back further. When we look at these annual indicators, we can only go back to about 1954 or 1955, as we did in this video. However, we do have price data going back further. This is 1934 here, and we can see the basic setup. Consolidation, sideways movement for a long period of time. This is several years. After a bullish breakout, good things happen for a long period of time. The market needs to consolidate its gains. After a bullish breakout, good things happen for a long period of time. The market needs to consolidate its gains. Now we have a bullish breakout. This point here is similar to this point here and this point here from a probability perspective. In this case, in the 1950s going into the 70s, the S&P 500 tacked on an additional, that's from this point here, so it rallies for years off the low, and then after the breakout, rallies for an additional 23 years and tacked on 580%. Similar situation here. You're rallying off a low, and then after you break out, you rally for an additional 18 years and tack on over 1,000%. Just as we did last week, this is the forest. We don't really use the forest for timing signals. The forest is the confirmation. As of Thursday evening, the S&P 500 had barely moved this week. It was down 0.1%. It's basically flat between Monday and Thursday. Therefore, as you might imagine, if the charts looked favorable from a tree perspective last week, they probably still look favorable as of Thursday evening. This is the look that we want to avoid. After we could see this, really bad things happened. After we could see all of this and measure it, the market went down, had an additional loss of 56%. This is the trend look that we want to embrace. This is the type of look we want to embrace. How does the present day look? On Thursday, November 9th, the market was down 9 points, but as I just noted, it's only down 3 points for the week. And as we might imagine, that's not going to impact the longer-term trends. That would take time. This looks a lot like this. After this point here, the S&P 500 tacked on an additional 156%. The present day looks a lot like this period here, and in this case, after we could see this, the S&P tacked on an additional 26% before experiencing a significant and sustained pullback. We know the CCM market model helps us discern between volatility to ignore within the context of an ongoing uptrend and volatility to respect where some incremental defensive action is required. And that description of our tool acknowledges that volatility is a normal and 100% to be expected part of every bullish trend. The more we can understand the hard data and use that hard data to keep our human emotions at bay, the easier it will be to avoid these common missteps. During a long-term secular bullish trend, it's important that we become comfortable with being uncomfortable from time to time during normal volatility. Let's recap the weight of the evidence that we've covered on the charts in this week's video. We showed a recent bullish moving average crossover that occurred on the annual chart. That's only happened 2 times since 1954. A bullish turn in the Bollinger Band width. CCI recently made a sustained push into bullish territory. TSI has a bullish cross. ADX with a bullish turn. RSI has a sustained bullish push above 70, signaling positive and bullish long-term momentum. PPO, we have a bullish cross. The Kopic curve has turned in a way that we can see, measure, and put in a model, and it's bullish. And rate of change is moving off the zero line in a way that has only occurred one other time since 1954. Every single one of these bullet points here has only occurred 2 times since 1954, one in the past and one in the recent past. Thus, if we double back to our original premise, is the aroma that's coming from the market kitchen bullish or bearish? In November 2017, if a bursting bubble were right around the corner, or a debt crisis was imminent, or the end game was near, or there was something sinister happening behind the scenes, we would expect the facts, the observable evidence that we have in hand to look more like this waning momentum look here. And we wouldn't expect it to look anything like a major bullish turn. And if we look at the bearish case on a shorter term time frame, even if we were expecting a 15 to 18% pullback, we wouldn't expect the daily moving averages that we covered earlier in this video on November 10th, 2017 at noon to look anything like this. This look here looks like a strong, existing, and sustainable bullish trend, which ties in nicely to this November 9th tweet. The market was red on November 9th. Prior to November 9th, there were 88 trading days in calendar year 2017 that were red. And 100% of them, all of them, were eventually, if we were patient, followed by a higher high. The simple and powerful definition of a bullish trend is a series of higher highs and higher lows. That definition implies if the existing bullish trend is still in place, then when you get a pullback, a higher high is coming at some point in the future, because that's what bull markets do. They're long-term bullish trends, and by definition, they must make a higher high after a pullback. Why are these concepts so powerful? Because if we ask ourselves a question during any pullback, does it look like a bull market? Does it look like an uptrend? If the answers are yes, then by definition, they imply that patience will be rewarded, because any pullback, by definition, would have to be followed by a higher high at some point in the future. Which means if I have a profit of X here and I'm patient during this pullback, I will have a profit of Y here, which is higher than X. And I don't have to make any trades between point A and point B. So in calendar year 2017, the market model, the master market model, has properly classified all 88 of these red days as volatility to ignore within the context of an ongoing uptrend. How do we know that? Or how do you know that if you're a client? We have not made any defensive trades with our core positions such as SPY in this calendar year. Any of the trades that we made earlier in the year were not because of the master model. They were due to the ETF scoring system, and we've addressed that issue. The master market model has called for basically a 100% exposure to stocks every single trading day of this year because the trends have been so strong. And that's why the primary objective of the model is to discern between volatility to ignore and volatility to respect, because at some point the pullback will warrant incremental defensive moves. If you've been a client for some time, or if you've been watching these videos for some time, you may remember back in 2016, we talked about the turn that occurred. Early in 2016, all of the data looked like we were in the early stages of a new bear market. Then the data quickly flipped, and we had a very rare nimble barge setup. The setups that we've covered in this week's video are basically the exact same concept, except fractals tell us we're looking at a much longer time frame. This is a very dire look here from a long-term momentum perspective, and eventually the barge flips. Dire look here, the barge turns. Why that's relevant? The longer the time frame, the lower the probability of a whipsaw when you're looking at charts like this. The barge doesn't turn very often. And right now, it looks like the barge has already turned and is in the process of turning in a very favorable manner. As always, we'll take it day by day. If the data changes, then our probabilistic outlook will be adjusted. But given the facts that we have in front of us, this is the base case. And that nimble barge type move, that is the stock market setup that has only occurred 2 times in the last 60 years. And the fact that the last turn occurred in the 1950s tells us all that what we may see in the next 5 to 20 years could be radically different than what we've seen looking back 5 to 20 years. We track all of this and convert it into a usable and actionable format in a reasonable amount of time. The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.